Well, the center rally started out with a bang. Sure, we had a couple bumps and bruises, but nothing that we couldn't get over. But the party came off the rails a little bit, didn't it? And a lot of it had to do with the Fed speaker and what he said on this date. And then from there, it was just sheer panic on the way down. So the question that we have now is, are we going to get that Santa rally, or are we going to get more of a hangover? Now, this volatility that we're seeing has created some really massive panic and some opportunity as well. The question really goes with what's going on under the hood. Why are we seeing such volatility? How did they do damage control this week? What's coming ahead, a Santa rally, or are we going to melt down? There's a lot of dots to connect, so let's just jump right into it. Now, before we get into all the details, you will be familiar with this graph if you've been following this channel for some time. What I like to do is take stocks above the 5, the 20, and the 50, and the 200 and overlay them and then look at where they are in regards to the S&P. I did create a new way of looking at this because I think that might be more helpful to people. But what we had are these levels that were just not sustainable. So we saw some kind of bounce on Friday. It's not realistic to have stocks above the 5-day moving average stay at 2%, meaning 98% of all of them are below. It's just not realistic. It usually bounces at this level. And if you tie these levels in with the 20, not so much the 200, but if you start tying them in with these other levels like the 50, and you're down to that 18% level, you start getting to those October 23rd levels. So we covered this on Wednesday, Thursday, and what I did was I mapped this out into another way of looking at it, which I think is important. But I've been having somebody help me with the YouTube channel, and one of the things that they noticed was that people that are subscribed, 27% of the people that watch these videos are not subscribed to them. And then out of those people, only 16% have clicked notification. So what we do here, you want to follow along as the day goes on, meaning the week goes on, because all these videos are connected. And then this video on Saturday leads you into the end of the week, meaning Monday, Tuesday, Wednesday, Thursday, Friday, how we're expecting it to play out. So you want to make sure that you do click all notifications when you're subscribed, and you want to make sure that you are subscribed to the channel if this is of interest to you and if you're looking for something that is going to be actionable that you can take into the next week. But I just thought those statistics were interesting. Now, if we look at the S&P, and we look in front of us, we have the 5, the 20, the 50, and the 200. And what I did was I stacked them on top of one another. And if there's a way for me to share this with people, I can just put it on that TradingView website. But what we can do with it too here is just collapse them for a second and look. And whenever you get to like a 2 or a 3 down here, there's the possibility of some short-term bounce. And what I was saying on Wednesday, Thursday is that we were kind of heading towards this direction after Wednesday. Thursday it became really clear, like, okay, this is pretty exhaustive what we're seeing. There were some other signs of it too, but when you start clicking through them, like the 5 and you look at the 20, you're getting to those levels where you were in like April 15, those kinds of pullbacks. This is marked off just for other areas, but you can see that even that October, November level, even down here in March 23, like this is pretty oversold. Look at this on the 50. And this one was the one that really got me, where I was like, okay, well, that's probably an area of bounce. So it's not realistic for 80% of all names in the S&P to be below the 50-day moving average. It's just not realistic, even from a defensive standpoint. And this is really important because when you bounce, it's not going to be the same names. And it's so important that when you crack, you're going to want to look at what goes and takes out new highs and what led. And I'm going to give you 3 areas that led later on in this video, because these 3 areas are where you should be focused on right now for going into the coming week. Now, you would look at this and say, all right, great, but what about the 200? Statistically, you never want to be below 50% of them below the 200-day moving average. But then if you stack these all up on one another, it tells you a pretty nice story of where you are from short to long term in regards to the S&P 500. So by identifying this was extremely helpful to us in understanding that a bounce was out there. Now, there were some other things that led to that bounce, and we'll get into that as the video goes on. But what I think is most important is understanding how this happened, how it's changing, how smart money and dumb money are looking at everything. The equity risk premium, what happened there? People need to take a look at that. And what are institutions doing towards the end of the day? When we connect all this, it gets us to answers. Those answers are things that we can take and make them actionable. Remember, when we look at the stool, everything we do is based upon the macro fundamentals and technicals. That makes up our stool, and then we go from there. But when we look at this and we have one action and then another reaction, we want to understand why. And to do that, we have to understand the participants. Sure, there were bounces out there. I'm sure we all saw the Bitcoin bounce from that level, that from the election, and how it hit here and then hit again. And yes, that's great. The question is level of sustainability of these things, where the money's going, and then how we can profit from it. So let's get to it. Now, in front of us is smart money, dumb money, but we don't call it that. We refer to this as institutional, and we refer to this as retail. Now, if you've heard this before, that's okay. It's just a refresher. But what we don't want to do is say that everything that institutions do are smart and everything that retail does is stupid. And what this does is it just allows us to understand what they're doing. Remember that institutions tend to take their time, where retail tends to act like a cat on a hot tin roof and just fall apart. Do the kids still say that? Again, this is also not me. This is Sediment Trader, which you can see down here, and they do a pretty good job, and I have no affiliation with them whatsoever. But I want to give credit where credit is due. It is their product. What we can see here by looking at this over a 3-year period is pretty simple. And this is really what I want people to get. I want people to understand that over 3 years, you have not ever really seen that many drops like this from retail, where we are straight down, even though retail tends to act super, super fast. Now, at the same time, what we're seeing is this bottoming pattern right here, and that bottoming pattern is happening where? That bottoming pattern is happening in the institutional side. Now, I want you to think about the institutional side, such as, are institutions buying stocks over equity or over bonds? If they are buying it over bonds, then yes, then equities are going to go higher. What's the reason for that? There's a couple of things that we're going to talk about with equity risk premium. We're going to tie all this stuff together today, guys, so that you're ready for 25. There's a lot here. Some people would look at it from this perspective and say, well, retail's seeing less and less interest. No, that's not really what's happening. You have to look at it from a percentage of how they're moving on various instruments. What I see here is I see a retail panic, and I see institutions taking advantage of that panic. But there's more to this too. We're going to tie this into the Smart Money Index, which is a completely different calculation. So when you see how all three of these things overlay, you're going to be able to use them more effectively. So again, I like tying all this stuff together because I think it's extremely helpful. But what we see here is retail panicking, and then we see institutions buying. Now, what was that panic? Well, that was really just Jay Powell having pretty much the worst Fed conference in probably 20, 25 years since I've been trading. I've never seen anything so horrific. Friday, they actually had to do covering for him, and we'll talk about that a little bit, the little damage control. Now, some of these concepts of institution versus retail might make you have to go back and relook at this. What I do with these videos is I pack it all in, and then you can take your time with it later on. But if we just go to this year level very quickly, you can see what we're looking for here, and you can see that change. It's not like it was slow. This is December, and then off of December, it's just like, boop, one day we came in and we just didn't want to own anymore. And I just want you to take a second and take a look at who's taking advantage of that. Okay, so when we're looking for those levels, who's really buying? Well, retail panics. Institutions are like, come on in, panic. So when you are out there trading, you have to think, do you want to be like retail? Do you want to be like an institution? Who makes more money? All right, so when you start connecting those dots, you might be like, okay, well, this might be something that I want to pay attention to. Now, the most important thing that I could tell you to take from this are peaks and valleys. That's the most important thing that I've noticed in all the years of studying this particular chart and these particular, the way that they do these calculations. It is the peaks and valleys and the relativism of them that determine what's going to happen. The speed in which they move as well. For example, if I have retail puking, and we do have retail puking to the level of this is the fastest and lowest and most pessimistic that retail has been, that's something I might want to know. And then here's just institutions down here just waiting in the wings, just waiting and just saying, oh, they'll panic. We're just going to wait for them to panic. And when they do, we're going to get in. And once again, why I'm going over this thought process is because when you look at this and say smart money, dumb money, you're not thinking that way. When I say institutions, retail, and you understand who the players are, you're thinking about it a little differently. Hopefully that helps why I do that explanation. So now we know that the retail side is a little scared, and now we know that institutions have just been waiting in the wings since about when? Well, if we look from November over, it looks like they've been waiting in the wings since about the election, doesn't it? And what we like to do is we like to look at the relative terms of how these two things move. But one thing I want to make really clear about looking at this, when you get to that peak level of institutions, which would be like a peak level here or a peak level here or a peak level here, what you tend to do is get a bottoming effect. And when you're down here, what they're waiting for is the panic of retail, and you're going to get the exact opposite of that, where you might get some kind of topping, right? So you can see the topping here. That doesn't always work, depends how fast institutions come in. So that's why you care about the relative move of these. Take a look at them. Now, for our purposes, we're going to take out 2020, and the reason for that is because you had 1.7 trillion that was injected into the stock market, and that, of course, created a lot of imbalance where people thought that that's what happened. You had the Fed put where they were literally out there buying U.S. equities. I mean, it was kind of crazy, but it is what it is. Nonetheless, what we have here is the smart money, dumb money spread. And we would just say institutions divided by retail, and that's going to tell us where the players are. This is really helpful in understanding the velocity in which these things are moving. But what we really want to pay attention to, again, is the peaks. And doing this simple math, this simple relativism, it tells us exactly what we're looking for. We're just looking for a peak, and then we're just waiting for that peak to end. And when we see that peak ending, well, that's probably a bottom. And it's not much more than that, is it? And so what you want to do with it is not just say, oh, well, that's definitely it. No, it also has to do with where you are relative to the line, et cetera, et cetera. There's a lot more to it. But what you will note is it does have a lot to do with the speed in which that happens. And we can get into the relative moves. For example, you can see how this one was higher and then how that kind of called the bottom of the market. But that also tied directly into magnitude and into RSI, which I might actually touch base on here because we've been using RSI in the community and doing very well. But this relativism where you see a divergence, there are things that you do want to pay attention. You just do. Even when you see them here, you just want to note them. Anyway, if we see this line, and this line would be an extreme reading, and this would be an extreme reading, and then people would say, well, do you act on those? No. What you act on is when you break these lines. When you break these lines, that's when you want to act on them. Because when you act on that, or when you, it could be actionable. Let me say it that way. That would be cleaner for me to say it. Because if I use that as a level, and I just use the break, up, over, and I just drop that, that is the movement where the imbalance happens. In other words, there's an imbalance there. Now, whether or not that imbalance lasts forever, or whether it's a small imbalance, I don't know. We could even use this one, but I don't know how long it lasts. But what I do know is that crossing the line is like crossing the Rubicon. And then once that happens, you tend to get some kind of top. Now, that one's a little, but you get where I'm going with this. So how long does that last? It lasts as long as it lasts, which isn't much to tell you, but it tells you where you are. So if we see more weakness and we start seeing some of this choppiness and walking down, then we can't be surprised by it because we're like, oh, this is what's going on. So what do you take away from this? What would be your key takeaway? Your key takeaway is that you're going to have a choppy market and that bottom is going to be in when this starts reversing. So we're going to monitor this in 25. So we would know that just because we bounced on Friday and we're talking about how oversold we were. We've been talking about that in the previous section and the previous days. Remember, guys, make sure you subscribe to this channel. All this stuff is connected. I looked it up. I think it's like 30% of you do not subscribe to the channel, which is kind of interesting. They're all linked. So when I was talking about Thursday's or Wednesday's video where I'm showing how oversold we are, and then you see what happens on Friday, you're not shocked by that. But there are movements where you could be doing something like this, and then there's movements inside of that where you could kind of be bouncing and trading down. Now, is that what's going to happen? Here's the bottom line. Nobody knows, right? I don't know if this reverses the next day because, we have a lot of uncertainty going on. But what I do know is that what we saw on Friday from the macro side actually shook the market. And also those comments shook the market. But we'll get into that in a moment, especially the comments from the other Fed members, which I was surprised it carried that much weight. Especially, I think it was PCE and those Fed members. But let's get to it. And we're going to just take a snapshot here for a quick second and just look at this and how fast you dialed in. So not only do you have to worry about these peaks coming, because when these peaks come, you're going to bottom. But here's what's really great about this. What I think's really great about stuff like this is I think that when you understand not only how this plays out, but the velocity in which you move. So in other words, the speed in which maybe you get over that zero line. Do we need to watch something like that? Maybe, because once you're over that zero line, are we nearing the end of that move? So if we just took that zero line and said, well, here we are, maybe we have something like that, and it happens fast. See it? So that's why we're zooming in here a little bit. See how this one never got to the zero line? So is it that zero line? Like, again, I'm going to use a really cool statement saying crossing the Rubicon. If you have a better statement you want me to use, just comment it below. But I like crossing the Rubicon. But you see where I'm going with this? So like maybe that's when this accelerates to the downside. So what we should probably be doing with this is just watching it and saying, is there something to that? And if so, then we need to monitor this much closer now than we have been. And that's what's really important. So I'm going to just roll back to the 3 year so you can stay with me here, but just see where I'm going with this. So when we got to that zero line, that's when it accelerates, right? When we cross that, we'll say it again with me, the Rubicon, that's when you start getting into those levels and going, okay, well, that's interesting that that's happening. And what do we do about that? Well, we just put ourselves in a position going, we may hit that. In other words, you may have an oversold bounce, and this is where I'm going with this, so you can say, like, where's he going with this? Because then I get asked that in the comments below, which please always ask. Well, here's where I'm going with it. What if we have that oversold bounce, and then we cross this, and then we have this coming? Most people are going to be looking at that and going, okay, well, we're just going to rebounce back up because we just did. No, we just had an oversold bounce back up. Now we might do this for a while and start working its way down. So we want to put a toe in the water. We don't want to get crazy, but we need to monitor this because are we going to get here and reject like we did here, or are we going to go over? So this is a really critical time for us to watch as we go into next week and as we go into 2025. Now we need to address the equity risk premium, but before we even go there, what we're going to do is just look at the smart money index. This is probably one of my favorite tools. There's two that I really like, but this is probably one of my favorite. If I look at the Smart Money Index, what it does is it takes a -1, for example, on the first half hour. So if the market's going up, it says retail, we're going to do the opposite of what retail is doing. And then if it's going up, at the end of the day, it's going to go +1. And that is the easiest way for me to explain how this goes. So as retail buys the open, this drops. As retail sells the open, this would go up. As institutions at the end of the day, and that's the first half hour, and the last hour of the day, what they're going to do is go, oh, they're buying +1. Oh, they're selling -1. So whatever retail is doing, they're doing the opposite in the first half hour in this equation. And whatever institutions are doing, they're doing +1 or -1. And that's going to get you this index. And that's what's so interesting to me about it anyway. But take a look at this. You can look from that 10-year over and see that you're at a level that you haven't been in some time. Now, what you want to see with this is just that kind of trajectory of constantly pushing. And you can even see here when you washed out and you just saw institutions buying why no one else believed, was literally the bottom of the market. It's never looked back. And from that date, all you've done is grind higher. So the idea that this isn't going to continue to go over the long term, you might want to just kind of check that. But there are some things here that we should talk about. When we drop it to a 5, what we'll start seeing is a little bit of development, meaning higher, 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 and you got it, right? And then all of a sudden you start seeing this, even though we're going higher. That's not ideal, but is that a reason to get out? No, it's not. So in other words, what you're going to see, you can see it here, right? And the problem with looking at this back data over 5 years is what? It didn't matter what institutions did. It didn't matter what retail did because you just had the Fed put in there. And the Fed was just out there saying, well, we have to protect people from themselves and we're just going to keep buying everything. And that's exactly what happened here. And that's how you get NFTs, and they changed them from NFTs and they're really just JPEGs. But this is what happens. And now look at where you are, right? And so if you just took a look from that point over on the S&P and you just drew a line, let's try to make that a little clearer. And then we looked at that bottom versus this. Well, it's not rocket science on what happened here. I mean, it really isn't. You can see the peak here. You can see when you got over that peak, and then you draw that line and you're like, oh, okay. So as soon as smart money flipped, this actually flipped and broke out, took out highs, and everyone's like, oh, we can't possibly go higher. But you're like, actually, I'm just watching this. Now, the one thing that I would take from it is look at the volatility versus the volatility that it's been. That's really important to get. See how the volatility of this is changing? That's a really important concept. And you can see that volatility a lot more when we draw right into what? When we take a time and we just go over from like September. But let's just take from this third quarter on and say, okay, well, here's really where we start seeing the volatility change, don't we? And what is that telling us? This is what people are not really getting about the market. They're not understanding that the volatility is pretty standard. And what they're doing is they're unwinding a lot of the stuff that was really protection. And this is why people didn't just always own technology names, because technology names would fall off a cliff. If you go and take a look at the average true range of names, you'll go see the volatility spikes in September 30th, and it really after the election. Some of your favorite names out there, even if they're not moving or haven't moved as much, their volatility has spiked to a level of 2 to 3 times in some cases. Tesla has moved greatly, but the volatility of that name has gone from something like 2 to 3x depending upon the day. And obviously MicroStrategies, I think, is like gone from a $17 daily move to a $50 daily move at this point, which is pretty insane when you think about it. But nonetheless, if we're taking a look at this, we're seeing this expand. Watch this over a year. Now, when we zoom in on the year, I think it does a couple things. And again, I'm going through this fast so you can always watch these parts again. But I'm going over this so that you can get what you're seeing. When you look here, you can see how once this started to change, meaning the smart money index, when this started to change, you get wild. What happened to the index? All of a sudden, the volatility picked up. And this is what was freaking people out a lot. They were watching the S&P move and have these volatile swings, and they couldn't figure out why the VIX was just standing there. Because it's not a big deal. This is pretty standard stuff to have this level of volatility. The one concern that I see is just that you're getting this kind of little bit of a divergence. And the question becomes, is that because of what we're seeing towards the end of the year, or did something else shift? I do think there's a little bit of a shift that we have to talk about with the equity risk premium and understand this is why smart money, dumb money is probably doing what it's doing, why it may break that zero line, why we might have other, short oversold rallies, and then we might have pullbacks. I think we really need to talk about this so people can wrap their head around one of the concepts that just really balance the market and the really big swaths of capital that are out there. Now, in front of you is equity risk premium. And what we've gone over so far and why it's important just to hammer this out, we've gone over the smart money, dumb money, and we've gone over that confidence spread and how you would take those two. And then on top of that, we have just gone over another portion of it, which allows us to understand how they're balancing, right? So we're going at the smart money, dumb money, we're looking at the correlation between them, and then we're looking at how they're balancing as the day goes on. And then the question becomes, why are they doing what they're doing? And this is where it gets interesting. At least to me, this is where it gets interesting. And I think it will help you understand what's going on and why do you care about the bond market. So in front of you is equity risk premium. And this is calculated very simply. You have what's called a risk-free rate. And that's going to be what? That's going to be your 10-year bond. All right, so you're going to have your 10-year bond, which is TNX. Anyone can go and look that up, but that's what it is. And you're just going to deal with my childlike handwriting because I'm not going to switch drawing tools. So you can just use TNX. That's not an X. Do this all over again, and I'm not going to have time to edit. TN, stay with me. Don't go to the light. TNX. There we go. There it is. All right. So that's your 10-year yield. That's what you want to look at. And once you're done looking at that, you're going to see what? You're going to see that the yield has broken above what? 4.5%. Right? And we did address this earlier. But once you see that, you have to just bear with my childlike drawing, guys. I can only do so much. But once you see that, you're going to be like, oh, well, why do I care about that? Okay, that yield is part of this equation. Once you have that yield, the next part of this is the S&P earnings yield, not dividend yield, earnings yield. And what you're looking at is what is the S&P earning per unit that I own versus the risk-free rate. Anything that's up here makes a ton of sense. And what I want you to understand is, and I'm only going to look at 10 years, this is some of the worst time to be buying equities for the risk that you're getting in equities versus what you're getting in bonds. It is some of the worst times out there. Now, why would you care about this? Because you're a trader and you're like, well, I don't care because I want to trade, MicroStrategies. I want to own names. It's the pension funds that care because they have assumptions. So pension funds go on the assumptions, let's say that CalPERS, for example, that they can earn 8% or 6% a year, whatever their number is that they need to hit to make sure that their money is there in the pension funds. Well, they'll look at this and go, well, right now, this is some of the cheapest bonds that we can go out there and buy. But you have so much uncertainty that we don't know that they want to buy bonds because our rate's going higher, our rate's going lower. They don't have a clue. And that's where the problem lies in, and that's what we need to pay attention to. So to get to it, why do you care? You care because it's expensive. The market is expensive, period. But it's been expensive. So is this antiquated? Does it not matter anymore? It matters because they have the money. Remember, when we trade, they are the sharks. We are the remora. We just pick up the pieces that they leave there for us, right? We're trying to find the way to get invested. And right now, bonds are cheap, period. That doesn't mean that they don't get cheaper. You have a lot of issues out there with inflation right now, and we're starting to see what I'm going to refer to as the real numbers. And we're going to leave it at that. But I really feel that way. I really feel like we're starting to look at the real data. Now, if we take a second and just zoom in here and realize, well, we undercut here, and then we're undercutting again. Let's zoom in this a little bit more. And then we can just tie this whole thing together. So if we cut under here, what this means for us is that we could see institutions wanting to buy more of this, which would then mean that the smart money index that we were just looking at, we could then see that that is not going to get bought as much, and that might lead to what we're starting to see there, which is where we're starting to see, oh, well, all of a sudden, remember that divergence that we had back there? Well, maybe that's why this is happening, because they're starting to buy bonds. And then it would also lead you to start seeing a little bit more panic where retail's buying off the open, right? And institutions are dumping. And then what that dumping is going to do is then it's going to trigger the other side of that, because you have to realize when you look at smart money, dumb money, which is not the smart money index, that they're looking at commercial hedging when they talk about how much money is coming in the market. So just because they have money in the market on the smart money index, or rather the smart money, dumb money confidence spread, they're commercial hedgers. They could be hedging. Okay? That's a really important part of that people don't understand. Devil's always in the details with this data. So what we want to watch is we want to watch to see what happens here in this equity risk premium. Now I'm going to show you the easiest way in the world to watch this, and then go from there. But the important thing is for you to understand all this and why you need to care. The number one thing for you to watch is going to just be TNX. It's just going to be the 10-year. If you understand this and you watch if earnings are going up or earnings are going down on the S&P, that's all you need. Now, my issue is this break. And when we see this kind of break out, this becomes an issue for me. And there's a couple things here from a technical standpoint that would give me reason to think that rates are going higher. Now, we know that there's some people out there that have been doing what? They have been selling bonds and they have been shorting bonds. And one of the core things you could see here yourself, just by doing even the most rudimentary, is just, you can always clone these lines, guys. It's just so simple. Clone them and you just see where they fit. Like we can all see this cup and handle. We can all see this break under this DTL. If we took a look at this on a weekly, DTL is downward trend line. But then if you came here and looked at this, it gets even worse. I mean, it gets like cup within a cup kind of stuff, right? You can actually see it. Like here's the mini cup. And then if you came here and looked at this, you can see this cup with it. It gets kind of goofy, but when you see this stuff, you really can't unsee it. So I think it's worth us talking about. And is this going to be an impediment to the market? Yeah, I mean, it 100% could be. It could be an issue, and we have to see if they can get it under control. Now, they seem to be suggesting they are, but you can see the weekly cup versus, the daily. Like this is nothing compared to what's happening here. And if you took this measured move, I don't even want to do it. I mean, I'll do it because you just asked me to, but I really don't want to do it. Like when you look at this, it's crazy, like that drop. Where you were, zero interest rates. So if you look at that and you say 70%, because you never take the points, you take the percentage of the depth of it, and you came up here and said 70%, like where does that put you? It puts you at like 586%, something like that. If you zoom out on everything I just did and you come and take a look at this DTL from here, you can see how broken you really are. And you've broken this massive trend line. And you started breaking it back in March of 22, right when the market collapsed. And since then, you've just been rocking and rolling. Historically, when you break something like this, you have the ability to get to the top of wherever this is. And I'm not suggesting that you're going to get there, but that top ties in perfectly here and puts you at 10%. I don't think you're going to see anything like that because everybody would just it would be sheer panic, especially the unwinding and what that kind of leverage, there's so much leverage out there, what it would do to the global financial world is just put it on its head. It'd be a disaster. But and that doesn't mean it can't happen, but it just means that they would have to do something sooner than later. But when you see this kind of thing and you understand where you are, it does give you pause. That understanding like, oh yeah, we are a little high up here, and bonds are getting better. I mean, 450 for 10 years is not the worst thing in the world when the equity risk premium looks like it does from a pension fund perspective. not from a perspective of you swing trading. So you have to think about what that means for your trades. And what to me that means for my trades is I have a much shorter term outlook on trading until this settles down and finds some legs. And we figure out what the heck they're really going to do and what the heck is really going on. And I think that's very important. Now, everyone knows my man crush is Druckenmiller. He's been shorting bonds and staying away from China. And this is since October. I didn't really get it. I didn't understand the shorting of bonds. And this is what makes these people so important to pay attention to. They're usually ahead of us. And they see things that we don't. One, because they have access to information that we don't. And two, their mind is just has more of a proclivity to understanding this stuff. I see this a lot. This happened in 2003 when I had one of my biggest losses ever. I didn't understand why people were buying oil when we were going into Iraq. And then they understood it. I didn't. So paying attention to what they're doing is very helpful. But Jones is doing the same thing. Talking about this reckoning, we're going to go broke unless they fix this. Now, say what you want about the market, but the one thing that I think that actually rallied us on Friday, I'm going to get to in a moment here, but I think this was important from November that he's saying that he's worried about government spending couldn't cause a big sell-off in the bond market, spiking interest rates higher. I think that this is very factual, and I don't think people understand how government spending affects the market. So if you just think about it from your own credit rating or FICO score, if you have a ton of debt, your score goes down on a percentage basis. Governments are no different. So why am I spending X to get Y when you can't even pay me? And that's the point of where he's saying, well, we're going to have our Minsky moment where all of a sudden there's a point of recognition going, what we're talking about is fiscally impossible, like financially impossible, like we can't pay the bills. And that becomes an issue. He plans not to own fixed income. Will be betting against the longer dated part of the bond market. Now, if you took a look at what they were doing, when we cut rates, all they did was what? Sell bonds since then. That's all they've done is just sell this as TLT, and all they've done is just sell bonds. Rallies, cuts rates again, sell bonds. And this is troubling. It's troubling for a couple reasons, and I'll tell you where the issues are with it, where I think the issues are with it. For one, home builders are hosed because they were just convinced that they were finally going to get some relief. So they start building again thinking that they're going to get all these cuts. Remember, their turnaround time is something like 7 to 9 months to get these projects out there after they already have the approvals, right? So their permits and everything are 7 to 9 months. So they're 18 months out from when they buy the ground all the way out on average. Every place is different. But once they have their permits and they want to get going, it's 7 to 9 months on average. So they have to go out there and plan. Well, they planned for all these cuts finally, and now this thing's coming home to roost. And you're seeing people understand that with Lanier and earnings and how these things are starting to blow up. So does this affect those types of organizations? Yes. It also will affect when you start looking at REITs. Because now REITs that we're going to be able to refinance, because now you're not going to get anywhere near as many cuts as we know with what just happened with the Fed, and we can address that in a little bit of detail, but I don't want to spend a ton of time on it because I think it's been hammered out. I'd rather talk about the actionable side of it. I think a lot of people know that the Fed cut rates. I think a lot of people know that it was the worst pretty much Fed conference that's ever been out there, to the point they did damage control on Friday, which actually led to some of this bounce happening, which I think was good. Before we go any further, let me just get this out. All this stuff is connected. And once you understand the connections, that's when it gets super interesting, because that's when you can benefit from all these connections. And I'm going to give you an example. So XLRE, the whole thing that we saw here was, they're going to come out of this because we're going to get to a point where they're going to be able to refinance their debt. Maybe, maybe not, right? So what we're seeing here with the delinquency rate on commercial real estate loans is, on a percentage basis, it's still going up. Now, you might not think it's a lot, but if you go to third quarter 22, and let's say you're at 0.6 or 0.7, right? Let's just call it 0.6. And now you come out, it's 2 years later, and you're at 1.5. Well, you're almost at a level that's a triple. And so when you think about that, that all of a sudden means that regional bank says, okay, well, every loan that we put on for commercial paper now has a 1.5% chance of defaulting. That means that those regional banks, what they have already is already going to increase the probability of a default, right? But now when they go and want to buy new paper or issue new paper on that debt, they're looking at it and going, well, our risk is 2 to 3x what we thought it was. This changes everything in the way that people think. Now, add to the uncertainty of what we're seeing going on in the market right now. Now, government spending does seem to seemed like which was good. It seemed like we got a wake-up call there a little bit this week, which is what we needed, and the government did not shut down and was actually able to take a 1,500-page document and make it about 90 pages. Shocking how that works when it's time to go home for Christmas. But I think what you have to take into account is we need that fiscal responsibility ties into all of this. And one of the things that I would tell everybody to do to understand what really happened on Wednesday is this. Now, I would actually play a piece of the clip, but I don't know with the way YouTube is if I can or not. But she was on the Fed Daily. She was on Bloomberg. I would strongly suggest you spend 10, 15 minutes, just Google this and look it up. It's on YouTube. It was excellent the way that it was done. Her explanation of where their head really is and why it is where it is really important. Okay. She came out and made some very clear points. Not Trump's proposed policy guided her forecast. Policy to be gradual and new phase with focusing on incoming data. And here we are, and she has a Twitter account. Some people call it X. It's Twitter for life. Thank you for having me on. You want to just go to this. It was 7 o'clock, I believe, on Friday where this was, but when you go to Bloomberg and look it in. But if you type her name in Bloomberg, you'll find it. But what she really hammered home was, we don't know what the new administration is going to do. So we don't really have any reason to act on it. And she really hammers this point home, and it was about 10, 15 minutes. And what we saw on Friday was a couple people do this, but she was very eloquent about it and really hammered like, hey, this is where we are, and these are the issues that I see, but we're not making decisions based upon what ifs. We're making decisions based upon data. It's definitely worth your time. Now, I want to talk about what we're seeing out there because it's really important to get, because if you understand what's happening, then you can take advantage of it, right? And what we're seeing is we're still seeing risk off. And I'll explain what I mean by that. When we have really good news on Lilly and it gaps up and all they do is sell it, once they do that, you understand where you are. So this was really significant for the market, meaning they popped up, they had the opportunity to liquidate their position, and they did just that. When you go to this on a 1-minute chart, and I do think there was some super fascinating stuff that happened about risk premiums and things along those lines. I thought that was just absolutely fascinating. What they did on Friday, there's a lot going. There's so much to go. The point I'm making is they were more concerned about the risk premiums of the market than they were even concerned about quad witching. And then the way that they were putting positions on. It's very, very different than what you see on a quad witching. Usually quad witching would be the precedent thing of this, like of the Saturday video, because of what happened. But they literally just ran buckshot all over it and had their own agenda. It was really pretty interesting to watch. Anyway, you can see Lilly spike on the NVO news. We'll get to that in a second. But what you have here is this open. So watch this pre and post open when we get rid of it. Look at this gap, and it just gapped down. Opens, the high was the open, gaps from here and down. That tells you it's risk off and they're just trying to lock stuff in. And when you see this kind of stuff, it tells you where you're at. So do you really want to go out there and be putting a lot of money to work? I think there's a spot for that. I do, and we'll talk about that in a little bit, and what I would be watching. But when we see stuff like this, you just want to pay attention to it. This presented such an easy short too. Like once you had this level and you could just see the test that held, and you could make the argument that the test should be here, but you cracked, you retested, you couldn't break it, and then you did this, and you started setting up in here, and then this gave way, where you're having your test, and you can't get over that level, and then you crack. And you see this crack right here. A lot of people are like, oh, you want to do it into the short. No, or when you're rallying. No, here's the thing. It's not only when you short these names, I might as well go through this. It's not only when you short, meaning the break, but it's the time of day. So in other words, if you're looking at these names and realizing that the beginning of the day is retail and the end of the day is institutional, once you can wrap your noodle around that, you can take advantage of it. For example, this break right here, this is what we're doing with the trade in the room at the time. So in other words, we're watching that level and we're watching that time frame, and then I'm just putting out that this is breaking down and has the potential to gap fill, meaning you have nothing but air in here. And then what you're starting to see is you'll start watching this play itself out, right? So as it starts to break, I'm trimming a little bit of it, but what I'm really focused on is my target. But what you're seeing, again, when I want to point this out, this is just a 5-minute chart. When you start to see this breaking down, and obviously you have this huge bounce, but when you start to see this breaking down, this is telling you where people's heads are in the market. They're telling you that it's risk off. Now, to me, it's not risk off everywhere. And I'll show you two things that are telling us it's not risk off everywhere, but that doesn't mean that you're just going to go through what you just went through. Well, just watch this. So when you start breaking down, you just keep looking, right? And then what we're doing is I'm just pointing things out where I'm saying, see how it spikes up right here? You can see this little area right here. See how it spikes up right in there? When you spike over, even on a 1 minute chart, and then you reverse and close it that low, it's telling you that you're going lower. It's telling you that, oh, all we were doing was looking for stock. We were just looking for demand because we have a ton of supply, and now we're going to break. And then the next bar is right below that, right? So it's telling you a story. You just have to be willing to listen to it. And then there's the head fake on the 5 that marks it down, and then we're up 13, did not trim, and we're staying with the target, but obviously some people are going to trim. And then you're trying to bottom and you start seeing the divergence taking off. And now once this changes and you see this divergence, this is a really good question, and I should ask for your comments. Please comment on this. My single greatest video when I went and looked at it the other day, I never look at this stuff, was this Ichimoku cloud video. Should I start doing more educational videos and posting them? I'm seriously considering that. I've done a couple like trade walkthroughs on how we did it, but I'm actually thinking of doing some educational videos that have more of that you can go back and review feel to them anytime. So if that's of interest, let me know. I'll probably keep them short and sweet and to the point, but I think it might be helpful. So anyway, you can see this RSI divergence. And once we start seeing that, we're like, okay, now we have to move the stop up. Now our dreams and hopes might be smashed and we might not be getting that level that we think. And then what we do is when it flips, I think it was like 71 or something, we just got out. Thank you very much. On to the next one. And then you can just see that once again, I am victorious and getting out of the way before this happens. And that's the thing about RSI. You need to understand how it really works because you don't want to be getting out into this. You want to be getting out into negative slippage as much, right? Or when it's dropping, positive slippage rather. You don't want to be getting out of your short into this. You want to be getting out of your short into this. I'd rather have it drop and be getting out when I have a signal like this versus trying to fight this little nightmare and losing like 50% of my return. Huge difference. We should probably do one on money management too, but let me know if you think that that would be helpful. Now, as I've stated previously, there was some signs of hope and there are some things here that I would pay attention to. But again, I think that we're seeing the oversold bounce, which we won't go over again. But we are seeing that oversold bounce, so are we seeing that and then are we just going to roll right back over again? And let me just be really clear about this. No one knows. No one has a clue. Even the people that you think have a clue. I mean, we had Tom Lee saying we're going to have a Santa rally, and you just had the single worst correction in the market that you've had in, 20 years, just out of nowhere. And the reason I say that is not because, the guy's nailed a bunch of stuff, but like nobody really knows. Like no one knew that Powell was going to screw up a conference call so badly that was going to create mass panic that you would have to go out there and have people do damage control for the Fed chair. No one knew that Itchy was going to screw up that badly, but yet here we are. So when we see stuff like this, we just want to pay attention to it. So this is the election. And everyone's like, yay, it's over. And then you just drop a VWAP from there, and you can see this massive move down, and then you bonk, massive move down, and then you bonk. So this is one thing out there that's telling me, okay, this may be an area of interest. This may be something that is going to stand the test of maybe it doesn't deal with the equity risk premium because of this possible strategic reserve. And if you think that there's not going to be some kind of splash headline on a strategic reserve, I truly believe that he will do something because he said he will. How significant, that remains to be seen. But there was other significance here. If you take a look at MSTR, this was significant. And this is from somebody that came in short on Friday and was doing a little dance. So, and we did really well, but with the short over the past couple of days. But anyway, here's my point. Look at this. Look at my volume. All my volume scans, it's over. It's over every single thing. Okay, so I go back and say, well, the last time that it did this, what happened? Meaning, oh, I'm under, and then I get a vol scan that pops over. Well, that was one. Okay, how'd that go? That went pretty well for me. Okay, so what I'm looking for is periods of time where that happened. But wait, there's more. So then if I take this 55, which is right here, I use a 12, a 22, and a 55, I understand that I could be wedged in here for some time. And that might mean that up in here, like for the 400 level, I might have an issue and you might build, blah, blah, blah. What we like to do with this is understand where we are and understand the 55s here. So the very first thing that I would do is go there and go, okay, well, I'm going to just drop a little line here and see how we acted there pre and post. Now, that level was a little lower, if you want to know, on Friday from where it is now, because every day it's moving. Let me just see if we can just grab it real quick. And what we'll do is just drop this to a bear, work with me, not against me. And then we'll drop this to a 5 minute. and just take a look at something. This is what you did in the morning. You got right to the 55 and you bounced right off of it. You also held 300, like a ton of bricks. So can Bitcoin sell down? Of course it can. But do you see where we're going with this? Do you see what's happening here? You got to the 55 and you tested. And I think that this is your demarcation line. I think this is really important to watch that. A close below the 55 would change how I feel about this. But when I see this, you have to look at this and go, this held. You might not have wanted to hold. You might have thought that the end was coming, whatever. You held and you bounced. So this would be the first thing out there that Bitcoin actually held that gave me some semblance that things has the possibility to hold. Number two, this chart looks god awful. We have our first green day in about 3 weeks. So what I want to just kind of point out here is if you go to this date, which is December, meaning that the first bar in December was negative. This is your first green bar on the S&P equal weight. First one. You have not had one. Now, does that mean that we're going to hold and everything's going to be rosy? But it's a sign that we undercut and bounce, meaning that the S&P for the first time is green on an equal weight basis in all of December. So that must mean that on some level they're putting money to work, right? Now, if we look at this from a couple different perspectives, number one, the RSI on the daily and go, okay, well, when was the last time that the RSI on the daily was here? And I just like looking at this stuff and going, oh, well, that was probably like around here. Oh, okay, was that a time? Well, then you were down around here. How'd that go? And again, you're not seeing these, we're just going to bounce and everything's going to be rosy. Like this got chopped up for a while before it held, right? And then you could see this, and then that got chopped up for a while before you held. So maybe you undercut, maybe you roll back over and then go. But what it is giving me is a little bit of hope here. Let's go to a 4 hour for a second. It is giving me a little bit of hope here that we are at a level that's so down that you may have some kind of bounce and start finding some stability. I don't know that that's the case, but it does. When I go back and I look at this data on a 4 hour, like, let me just put this in perspective. You only have the pandemic. That's the only time on a 4 hour chart that you've ever been here in anything in the past 5 years. Okay. So, I mean, you can obviously go back further if you want, start getting into 1918, 19. But if you're going to look at a body of work over 4 hours, which I think I tend to break it down on the hour and the 4 hour and just look for these kinds of anomalies. Could this get worse? Well, yeah. I mean, it got worse here, didn't it? Before it bounced. But you try and you start looking at it saying, okay, is there something here? Do we want to get involved? You don't want to be here, in my opinion, shorting at that stage. You want to be looking and saying, can we get involved? Is there a way for this to bounce? Now, if I do the simplest of things and drop the 200-day in, you're going to find that that's around that 170 level, and every day that's going up about 20, 30 cents. If you look at this on a weekly basis, you're very far off of it. You're not near it. Like here you cut it. And so that could be the other argument that you have to get to that level to have a complete washout. And maybe there's something to that. Maybe there is. But to me, when I look at it and go, now I think you have a shot at least of bouncing and going there. Number three that I think is really important. And let's start here. Look at the XLK and the undercut. Now let's flip to this and understand what we're looking at. A 12, a 22, and a 55. You should use what you're comfortable with. What did we do? We undercut the 55 and we bounced. So what we would do here, and again, you can see how we look at the technical, the fundamentals, et cetera, et cetera. But what we're doing here is let's get rid of the volume. You can see that the volume's over, but let's just not get ahead of ourselves. Let's just look at the simplest of things and break it down. What do we get? We get an undercut and a bounce. Okay, well, there's three names in there, and this is where I think it gets really, to me, it got really interesting. Take a look at Apple. We have an all-time high close on Apple after an undercut. Look at Microsoft. Okay, Microsoft does not look anywhere near as good. Look at NVIDIA. So we're taking the top three. How does that look? I mean, I've seen it look better. It's not really, making me feel warm and fuzzy. I felt warm and fuzzy before. It doesn't feel like that. But if I look at Apple and we look at the world's largest company and we see it hitting all-time highs and closing at all-time highs. And that's what my weekly looks like. So if I look at those three pockets and say, yeah, maybe we do have some strength out there, and maybe we should look for some kind of either a oversold bounce or at least sideways, and some of these names outperforming as we go forward next week, and then we move into 2025.